Hi, this is James Shugg with Westpac London's end of market report for Friday, April the 13th. Look, European concerns are very much back on the agenda today, and certainly one of the reasons why markets in Europe in particular are down sharply. But the day started off badly following the Chinese GDP figures. Came in a little bit weaker than our forecast. We were on 8.2%, came in at 8.1, market was expecting 8.4. And that was down, of course, from closer to 9% in the previous quarter. As one of my colleagues has pointed out, the primary, which is like agriculture, the secondary, like manufacturing, and the tertiary sectors, services, retailing and so on, are all now growing just at a single-digit growth pace. And the only times they've done that before were during the Asian crisis in the late 90s, the tech wreck about 11 years ago, and more recently in the global trade downturn about 3 years ago. So it's not a particularly deep downturn in China yet, but it's certainly a broad-based one. And I think, combined with the wobbles that are occurring in terms of the US data at the moment and the deep concerns about Europe, it does look like the risks to the global growth story remain very much to the downside. So that was one concern for markets in China. Secondly, the Bank of Spain today released figures which showed that Spanish banks took more than a quarter of the long-term refinancing operation of the European Central Bank late last year and earlier this year. Now, other figures from the Treasury in Spain show that Spanish banks between November and January lifted their holdings of government bonds, Spanish government bonds, by 42 billion euros. Now that only was after the first LTRO. The second LTRO, of course, is in late February, and we haven't got figures subsequent to January yet. But although the LTRO gave funding to the banks, enabled them to buy the bonds of the sovereigns and help pull yields down, which meant governments could fund themselves cheaper, and made profits or lower losses for the banks on their positions, and that was seen as a clever policy response to the crisis earlier this year. That very same set of facts is now spooking markets because it emphasises the interrelationship between the fragile banking system in Spain, the indebted government in Spain, and both of which are operating in a recessionary economy. So what seemed like good a few months ago is now seen as actually adding to the risks down the road for the European sovereigns. So Spanish bond yields are back around or just under 6% at the moment. They're at 5.3% at the start of this month. Italian bond yields went up for the ride too, up 12 basis points today. We had Italian industrial production figures come out, which fell for the second month running, and they're now running a 3.5% annual pace of decline, which is what they were running during the first few quarters of recession in 2008, before the global trade collapse took things even sharply lower. Then we had figures come out which showed that American consumer sentiment slipped slightly in April. This was the preliminary release from the University of Michigan. The two components of that, the current conditions component slipped to its weakest for this year so far, although the outlook component actually rose to its highest since September 2009, when the economy was just coming out of recession. But the market took the overall picture negative. The fact that people think things have deteriorated since the end of last year, and the overall slippage in the index took markets lower, given that they're already very sensitive at the moment, I think, to weaker US data following the run of weaker news on the US jobs market since the weak payrolls report last Friday. Now, at some point it might be that weak US data will actually be a positive for stock markets, because it might be seen as adding to the case for another round of quantitative easing, which markets love because it means lots of free money to boost asset markets. But for the time being, at least, it's actually been seen as a negative, and that's they're the main reasons why markets are lower today. We had US inflation figures as well, came in as expected, 0.2% core, 0.3% on the headline. Okay, so where are markets? Well, at the close of trade, the FTSE were down 1%, but the French market down 2.5%, the Germans down 2.4%, the Spanish market down 3.6% today, and the Italians off 3.4% at the close. And as I speak, the Dow in the US is down around 2/3 of 1%. It's at 12,901. Commodity markets have been hit by all this. Copper prices down 2.8% today. Gold's off 0.8%. It's at $1,666 an ounce. There you go, 666 on Friday the 13th. And crude oil is down 2/3%. A lot of these sixes around, at $102.98 a barrel. The Aussie dollar's taken a bit of a hit. It's at 1.0365 at the moment. It's down around a cent basically since the Chinese GDP came out. So we had China hit the Aussie dollar. The weaker US data gave it a bit of a kick lower, and also the increased risk aversion related to the Spanish story, the European story, also tending to weaken the Aussie dollar. That's it for me. The futures market for Australia is implying it'll open about 0.75% lower, but that could change once I turn off the cam. Other than that, I'll look forward to speaking to you all next week.